Welcome to the Deep Dive. We sift through the earnings calls so you don't have to. Today we're digging into Motorola Solutions, ticker MSI, and their Q3 2025 call. And this one's a real head-scratcher, actually. You've got a quarter full of operational records, they raise the full-year earnings forecast, and then, boom, the stock pulls back pretty hard the next day. It's quite the puzzle.
It really is. And that's the gap we need to explore for you today. I mean, management sounded incredibly confident, right? Really bullish, highlighting the strength in public safety. But the market, it looks like investors just skipped right past that beat and raise narrative. They seem focused squarely on, let's say, near-term macro stuff, government policy, tariffs, maybe even valuation concerns. So our job is to unpack that disconnect. Why did such a strong operational quarter lead to, well, selling?
Okay, let's start with the highlights then, because operationally you can't really fault them. MSI beat consensus, top and bottom line. Non-GAAP EPS came in at $4.06. That's what, about $2.21, better than the $3.85 estimates. A solid beat.
Yeah, that's up 9% year over year. Strong growth there.
And revenue.
Revenue also solid, $3.009 billion. Just nudged past the $2.99 billion estimate. So up 8% year over year. But like you said, it's not just the beat, it's the quality of the results. The operational leverage was really showing.
You mean the margins?
Exactly. Non-GAAP operating margin expanded 80 basis points compared to last year, hit 30.5%. That's pretty impressive stuff.
30.5%, that's a strong number. And that margin story is central to MSI, isn't it? They have this track record of high incremental margins as they shift more to software.
Absolutely. Often hitting, 40% or even higher on incremental revenue. And you saw the efficiency in cash flow, too. They pulled in a record Q3 operating cash flow, $799 million, just shy of $800 million.
Wow. Okay. And what about future demand? Backlog.
Rock solid. Another record there. Q3 ending backlog hit $14.6 billion. That's up nearly $500 million year over year. I mean, think about that. $14.6 billion. That's like years of revenue visibility, especially for the higher margin services side.
Right. So let's just lay it out again. Record earnings, record cash flow, record backlog. They raised the full year EPS guide. Margins are expanding, yet the stock sold off. There has to be something specific the street glommed onto. What were they worried about?
Well, it really seems to boil down to the forward-looking picture, the potential bumps in the road ahead. But before we get to those risks, we really should appreciate the strategic engines management is counting on.
Agreed. Let's dive into the segments, because this is where that shift to software really comes into focus, right?
Exactly. The strategy is all about moving towards those higher margin, stickier revenue streams. Software and services, S&S as they call it. That segment grew 11% in the quarter. Hit $1.112 billion. Strong growth.
And the traditional product side?
Products and systems integration, or SI, that grew to a healthy 6%, up to $1.897 billion. But the really telling number is the S&S backlog. That piece alone hit an all-time high of $11 billion. So most of their future committed revenue is actually in that higher margin category.
Okay, and speaking of strategic drivers, the Silvus acquisition was a huge topic on the call. That was the big $4.4 billion deal they just closed. Management sounded, let's say, extremely positive about its immediate impact. How positive are we talking?
We're talking pretty significant outperformance right out of the gate. So initially, they thought Silvus would add about $475 million in revenue for fiscal 25. They've already upped that number to $500 million.
Okay, $500 million. Where did the extra come from so quickly?
Well, part of it was a $25 million order for Ukraine that got pulled forward, which, highlights the immediate defense relevance. But the bigger story, the one investor should really track, is the earnings accretion.
Ah, right. Did they raise that forecast too?
They did, and quite substantially. They're now guiding for $30.40 per share in EPS accretion from Silvus in 2026.
30 to 40 cents. What was the original estimate?
Just $1.20. So they basically doubled the expected earnings contribution for 2026 already. Look, when you spend $4.4 billion, you need to show value quickly. And framing Silvus as the leader in mission-critical data is how they're doing it.
Okay, let's unpack that term. High speed, low latency, mobile, ad hoc networking. What does that actually let MSI do that they couldn't before?
Right, it sounds like a mouthful, but it's key. Think about their traditional strengths: LAN, mobile radio, LMR. That's fantastic for voice. Rock solid mission-critical voice. But LMR isn't great for lots of data. High bandwidth stuff like streaming video from a drone or complex sensor data or detailed maps in real time. Silvus provides that missing piece. It creates this kind of self-forming, self-healing mesh network. Imagine radios automatically connecting to each other, routing data efficiently, even where there's no cell towers or the existing network is down.
Okay, so it's the data plumbing for tough environments, like for drones or robots or soldiers in the field.
Exactly. And that opens up huge new markets for MSI. We're talking international defense customers, the US DoD, definitely border security, and that whole booming area of unmanned systems, drones, and the like. It's a shift, really, from just managing critical voice to managing all critical communications voice and data.
That's clearly the future direction. But let's not forget the core business. That LMR base is still massive and generates a lot of cash. How's that holding up?
It's incredibly durable. The reason is these systems require huge, expensive infrastructure refreshes, usually on something like a decade-long cycle. And right now, MSI is in the middle of deploying its new D-series infrastructure. That's the first major platform upgrade in about, 12 years? So it's a big investment cycle for their customers.
And we saw proof of that scale in the Q3 results, didn't we? Big state contracts.
Oh, yeah. They highlighted some major multi-year deals. There was $110 million from Colorado, $84 million from Tennessee's Department of Safety, another $82 million from a different U.S. state agency. These aren't just one-time product sales. These are long-term infrastructure deals that lock in customers and guarantee that future high-margin services revenue we talked about feeds right into that backlog.
But MSI isn't just selling hardware anymore. They're layering software and increasingly AI on top. That new SVX body-worn device sounded interesting, more than just a camera.
Yeah, that's the key pitch.
Yeah.
It's an assistant, an efficiency tool. And efficiency tools command better margins, right? The AI features they're building in seem pretty practical, things like real-time language translation on the scene, or using AI to help generate the narrative for incident reports. Their claim is pretty bold. They say it can cut report writing time by over 50%.
50%, that's huge for a police department. Think about the officer hours that frees up. That's a tangible benefit that justifies the cost.
Exactly right. It shifts the conversation from how much does this camera cost to how much time and money can this solution save us. It makes them more of a partner. And you see that same kind of value proposition with their cloud video offering, Avigilon Alta.
Yes, the cloud video piece. How's that growing?
It's growing incredibly fast. Management said Alta grew over 4 times faster than the overall video segment growth, which was about 7% in Q3. So that cloud migration is definitely paying dividends.
Okay. And did they give any forward-looking metric on how that software adoption is tracking, like how many devices are using these new apps?
They did. They actually raised their forecast for Apex Next devices. Those are the newer radios that will be subscribed to applications. They now expect 300,000 devices subscribed by the end of 2026. That's up significantly from their old target, which was 200,000 by the end of 2025.
Wow, so 100,000 more devices and pulling the timeline in, essentially. That definitely shows accelerating adoption of the software ecosystem.
Confirms that future revenue mix is shifting firmly towards software.
Okay, so we've laid out this really strong operational foundation. The core LMR is solid. The software shift is accelerating. Silvus is already outperforming. Now we have to confront the bear case. What specifically spooked the market enough to cause that sell-off? Let's get into the guidance and the macro risks.
Right. And it's important to note the guidance itself wasn't the problem, not really. Management actually stood firm on the full-year outlook. They kept the FY25 revenue target at $11.65 billion. That's still around 7.7% growth year over year. And they raised the non-GAAP EPS forecast slightly to between $15.09 and $15.15.
Okay, and Q4 specifically.
Q4 revenue growth is guided to be around 11% year over year. So the numbers themselves look fine, even strong heading into year end.
So if the numbers are okay, the negativity must be purely about external factors, the macro context. What were the main worries?
There were 2 main themes that seemed to grab the market's attention, providing the rationale, let's say, for the negative reaction. First and probably foremost was the risk of a potential U.S. government shutdown, specifically an extended one.
Okay. How does that impact MSI? I thought most of their business was state and local.
Most of it is, and that part's fine. But they do have significant federal customers. Think Department of Defense, Department of Homeland Security. An extended shutdown means federal agencies might not be able to formally accept large shipments or sign off on project milestones. That delays revenue recognition. It pushes Q4 revenue into Q1.
And the market hates anything that messes with quarterly timing, even if the business itself is fine long term.
That's precisely it. Management was really clear. This is only a timing issue. It's not lost business. Any delayed revenue just shifts into 2026, adding to that already expected $12.6 billion revenue base. But you know how it is. Near-term uncertainty, especially around guidance, tends to get punished.
Right. Okay, so shutdown timing risk was number one. What was the second major headwind? Tariffs.
Tariffs, yeah. They continue to be a drag. Management flagged about $70 million to $80 million in tariff impact expected just in the second half of this year.
But wait, I thought they were mitigating that. Dual sourcing, moving inventory, why is the impact still so high?
Mitigation helps, but it doesn't just eliminate the cost overnight, especially for complex supply chains. It's more like softening the blow. And the other factor is the timing of comparisons. They expect this tariff headwind to kind of linger into the first half of 2026.
Why into next year?
Because they'll be comparing those quarters, Q1 and Q2 of 26, against quarters in 25 where maybe the tariffs weren't fully in place yet, or where they still had some pre-tariff inventory they were working through. It creates a temporary, unfavorable year-over-year comparison early next year.
Got it. So it's like an echo effect from the tariffs.
Yeah, something like that. It just takes time for those costs and comparisons to fully work through the system.
Okay, so the gap seems crystal clear now. You've got management focused on the long game, the structural shift to software, the big LMR upgrade cycle driving backlog, the Silvus deal adding significant growth in earnings, all pointing towards sustained growth and margin expansion into 2026.
Right. They see the fundamental strength.
But the market, it got spooked by short-term, potentially transient issues, the risk of a Q4 shutdown messing with timing, and these lingering tariff headwinds hitting comparisons in early 26.
It's that classic tension, long-term fundamental story versus near-term noise and fear.
Which brings us perfectly to our not financial advice segment. Time to brainstorm a wild but maybe plausible trade idea based purely on this earnings call. For intellectual stimulation only, of course.
Okay, let's put on the hedge fund hat for a moment. Given this price action, the stock seems to be completely ignoring that raised 2026 EPS outlook, especially the double accretion from Silvus. So the volatility we're seeing now, driven by these macro fears, the shutdown, the tariffs, it actually might present a, let's call it a unique entry point for someone playing the longer-term theme.
Betting that the core strengths will win out over the temporary headwinds, what's the actual trade structure then?
The core idea is long MSI, but hedge the specific near-term risks. The thesis is straightforward. That core public safety demand isn't going anywhere. Look at the backlog, the big state orders for the D-Series upgrade. That's resilient. And the M&A with Silvus is clearly working better than expected, plus the software drivers like Avigilon Alta and the Apex apps. That whole mix shift justifies a higher multiple down the road than where it's trading now.
Okay, so going long, the stock captures that long-term view. How do you specifically hedge against that Q4 shutdown risk or the tariff noise that caused the immediate drop?
So you establish the long stock position, maybe averaging in given the volatility, but then simultaneously you can look at buying some short-dated puts. Or if you're comfortable with capping your upside a bit, maybe selling some covered calls against the long stock position. The key is targeting the options expiry around that Q4 guidance period, maybe early next year.
So you're essentially betting the current dip is an overreaction.
Exactly. You're betting that the market has overpenalized the stock for these Q4 timing risks and tariff echoes, which are likely temporary. And importantly, you're betting that the market is undervaluing the structural impact of that $0.30 to 40-cent Silvus accretion coming in 2026.
And the confidence for that long-term bet comes back to their track record on margins, right?
Absolutely. The real kicker here, the long-term driver, is MSI's proven ability to expand operating margins. That 40% plus incremental margin capture they've shown, that's the engine for value creation. They're navigating these headwinds while still planning for margin expansion again in 2026. The market seems caught up in the temporary static. The trade idea bets on the enduring strategic execution.
Okay, that definitely puts the dichotomy into sharp relief. Let's recap then. Motorola Solutions put up a very strong Q3. We saw records in cash flow, backlog, and they raised the full-year EPS guidance. This was really driven by that accelerating Silvus contribution and the continued momentum in cloud video and AI software.
Operationally, the company looks very healthy. They're laser-focused on those sticky, mission-critical solutions that public safety agencies have to buy, regardless of the broader economy. The market's negative reaction seems almost entirely tied to those short-term worries about government shutdown timing and tariff impacts. It creates a really clear divergence between the underlying business fundamentals and the recent stock performance.
A divergence indeed. Well, thank you for joining us on this deep dive today. It certainly leaves you with something to think about. How much weight do you give to that proven mission-critical resilience versus the noise of near-term macro and policy uncertainty? Does the long cycle outweigh the short-term fear? Until next time, stay curious and stay well-informed.